Welcome to Financial Analysis and Financial Ratios. Today we'll explore how businesses measure performance, compare competitors, and make strategic decisions using tools like standardized statements, financial ratios. Just clarity, let's begin. Imagine comparing a startup to a Fortune 500 company. Standardized financial statements make this possible. Common size balance sheets. Every asset, liability, and equity item becomes a percentage of total assets. This reveals how much cash, inventory, or debt a company holds relative to its size. Common size income statements. Each expense and profit line is a percentage of sales. This shows if a company spends 10% on marketing or 30% on R&D, regardless of revenue size. Think of it as translating financial data into a universal language. It's perfect for spotting trends or red flags across industries. Ratios analysis. Liquidity ratios answer a critical question. Can this business pay its bills this year? Current ratio. Current assets divided by current liabilities. Quick ratio. Excludes inventory. Focusing only on cash, receivables, and marketable securities. A stricter test of liquidity. Cash ratio. The most conservative measure, cash alone versus liabilities. These ratios act like a company's financial pulse check. Too low, risk of cash crunches. Too high, idle resources that could fuel growth. Solvency ratios reveal if a company is walking a sustainable financial tightrope. Debt to equity ratio. Total debt divided by shareholder equity. Times interest earned, TIE. Earnings before interest and taxes, EBIT divided by interest expense. Cash coverage ratio. Adds non-cash expenses like depreciation to EBIT, offering a fuller picture of cash available to cover interest. High debt isn't inherently bad. It can amplify growth, but balance is key to avoiding collapse. Activity ratios measure how efficiently a company converts resources into revenue. Inventory turnover equals signed sales divided by average inventory. High turnover equals strong demand or lean operations. Days sales and inventory, 365, divided by inventory turnover. Receivables turnover equals signed sales divided by accounts receivable. Slow turnover, maybe lax credit policies. Total asset turnover equals signed sales divided by total assets. Higher is better. Profitability ratios show if a company's efforts translate into real profit. Profit margin equals sign net income divided by sales. Return on assets, ROA, equals sign net income divided by total assets. Measures how well assets are deployed. Return on equity, ROE, equals sign net income divided by shareholder equity. Investors love high RO. It's their return on investment. Market ratios reflect verdict on a company's future. Price to earnings, PE, equals sign stock price divided by earnings per share. A PE of 25 means investors pay $25 for $1 of earnings, common in high-growth tech firms. Market to book, MB, equals sign market value per share divided by book value per share. A PE of 25 means investors pay $25 for $1 of earnings, common in high-growth tech firms. Think brand value or patents. In summary, ratio analysis are: 1. Profit margin. How efficiently sales convert to profit. 2. Asset turnover. How well assets generate sales. 3. Equity multiplier. How much debt fuels growth. ROE equals profit margin times asset turnover times equity multiplier. A high ROE could come from stellar margins, efficient asset use, or strategic debt, or all three. This framework helps pinpoint strengths and weaknesses. Financial analysis isn't just numbers. It's the story of a company's past, present, and future. Ratios and standardized statements are your tools to decode risks, efficiency, and growth potential. Ready to become a financial storyteller?